Have you ever seen a stock paying a 10% or even a 15% dividend yield and thought, wow, that's free money? If you have, you're not alone. Most beginner investors assume that the higher the dividend yield, the better the investment. But what if I told you that some of the highest yielding stocks are actually the most dangerous? In fact, chasing dividend yield has destroyed millions of rand in investor wealth over the years. And today, I'm going to explain why. By the end of this video, you'll know how to spot what's called a yield trap, how professional investors evaluate dividend stocks, and why a company paying a smaller dividend today could actually make you much richer in the long run. Hello everyone, and welcome back to FinEd, your favorite financial education channel. Before we begin, please do us a huge favor and press that subscribe button. Now, let's jump in. First, let's understand what dividend yield actually is. Dividend yield is simply the annual dividend a company pays divided by its current share price. Think of it as the annual income you're earning based on today's share price. For example, imagine company A pays a dividend of 1 rand per share every year. If the share price is 20 rand, the dividend yield is 5%. Simple enough. But here's where many investors get caught. Let's say the company's business starts struggling. Investors begin selling the stock. The share price falls from 20 rand to 10 rand. Has the company increased its dividend? No. You're still receiving 1 rand. But because the share price has been cut in half, the dividend yield suddenly jumps from 5% to 10%. Notice something important. You didn't become richer. The company didn't become more generous. The dividend yield only increased because the market believes the business has become less valuable. That's why dividend yield can sometimes be misleading. A high yield isn't always a sign of a great investment. Sometimes it's a warning sign. This brings us to one of the most important concepts in dividend investing, the yield trap. A yield trap is exactly what it sounds like. A stock looks incredibly attractive because it's paying a massive dividend. Investors rush in hoping to earn passive income, but underneath the surface, the business is actually deteriorating. Eventually, management cuts the dividend. The share price falls even further. Now investors lose both their income and their capital. That's why experienced investors don't ask, what's the dividend yield? They ask, can this company actually afford to keep paying this dividend? So how do you tell the difference? There are 4 major warning signs. The first is an extremely high payout ratio. A payout ratio tells you what percentage of a company's profits are being paid out as dividends. Imagine earning 100,000 rand per year. If you spend 95,000 rand every year, you don't leave yourself much room for emergencies. Companies work the same way. If they're paying out almost everything they earn, one bad year could force them to reduce or eliminate the dividend. Many healthy businesses pay out somewhere around 30 to 50% of their earnings. Once payout ratios start climbing above 80 or 90%, investors should investigate carefully. The second warning sign is weak cash flow. Here's something many beginners don't realize. Companies can report profits on paper while actually running out of cash. Accounting profits and cash are not the same thing. Dividends are paid using cash, not accounting earnings. That's why investors pay close attention to something called free cash flow. If free cash flow keeps falling while dividends stay high, that's often a red flag. The third warning sign is excessive debt. Imagine borrowing money every month just to pay your household bills. Eventually, the debt becomes overwhelming. Companies can fall into the same trap. Some businesses continue paying generous dividends while taking on more and more debt. When interest rates rise or profits decline, that strategy quickly becomes unsustainable. The fourth warning sign is unstable earnings. The best dividend companies have predictable businesses. Think about companies selling toothpaste, soft drinks, household cleaning products. People buy these products whether the economy is booming or in a recession. Stable earnings make stable dividends possible. On the other hand, businesses with unpredictable earnings often struggle to maintain consistent dividend payments. Now, here's something that surprised many investors. Researchers looked at decades of stock market history. You'd expect the highest yielding stocks to deliver the best returns, but that's not what happened. Instead, companies with the second highest dividend yields consistently outperformed both the highest yielding companies and, in many cases, even the broader market. Why? Because many of the highest yields turned out to be yield traps. Meanwhile, companies paying moderate but sustainable dividends continued growing year after year. And here's another fascinating statistic. Since 1960, around 85% of the S&P 500's total return has come from reinvested dividends and the power of compounding. Think about that. Not just capital growth. Dividends reinvested over decades created the overwhelming majority of investor wealth. That's why dividends matter. But sustainable dividends matter even more. So if the highest yields aren't the answer, what should investors look for instead? Dividend growers. These are companies that consistently increase their dividend every single year. Maybe they only pay a 2 or 3% dividend today, but next year it's a little higher. The year after that, it's higher again. And 10 years later, investors are earning significantly more income than they were at the beginning. Even better, the companies that consistently grow their dividends have historically delivered higher long-term returns while experiencing lower volatility. In other words, higher returns, less risk. That's exactly what every investor wants. Many of these businesses belong to an elite group called the dividend aristocrats. These are companies that have increased their dividend every single year for at least 25 consecutive years. Think about what that means. These businesses survived recessions, financial crises, inflation, interest rate hikes, global pandemics, and they still manage to reward shareholders every year. Companies like Coca-Cola, Procter & Gamble, McDonald's, Walmart. These aren't exciting businesses, but they're incredibly reliable. They generate consistent cash flow. They have strong balance sheets. They operate brands people trust, and they don't need to take unnecessary risks just to keep shareholders happy. That's why their dividends keep growing. Notice something else. Many dividend aristocrats don't even have spectacular dividend yields. Their secret isn't paying the highest dividend. Their secret is paying a dividend that grows year after year. This is an important shift in mindset. Don't ask which company pays the biggest dividend. Instead, ask which company is most likely to still be increasing its dividend 10 years from now. Those are very different questions. Now, does this mean you should never buy a high yield stock? Not necessarily. Some genuinely healthy companies do offer attractive yields, but they require much deeper research. You need to understand their cash flow, debt levels, profitability, business model, competitive edge, and whether the dividend is actually sustainable. Finally, remember that dividends aren't the only way companies create wealth. One of the greatest investment companies in history, Berkshire Hathaway, has never paid a dividend. Instead, it reinvests profits back into the business. Over several decades, that strategy created extraordinary wealth for shareholders. So whether a company pays dividends or not isn't the most important question. The real question is, what is management doing with the company's profits? Are they allocating capital wisely? Are they growing shareholder value? Are they building a stronger business? Those are the questions that separate successful long-term investors from everyone else. So here's the biggest takeaway from today's video. Dividend yield is the beginning of your research, not the end. Whenever you see an attractive dividend yield, ask yourself 4 questions. Is the payout ratio sustainable? Is the dividend covered by free cash flow? Does the company have a healthy balance sheet? And has management consistently increased the dividend over many years? If the answer is yes to all 4, you may have found a quality dividend company. If not, you might be looking at a yield trap. If you found this video helpful, please give it a thumbs up, subscribe to Fined, and share it with someone who thinks the highest dividend yield is always the best investment. As always, remember that this video is for educational purposes only and is not financial advice. Thank you so much for watching, and I'll see you in the next one.